So one of the
You are currently the only person in this conference.
Hello, everyone. Welcome to our pre-recorded lecture for Chapter 13. We'll get started in 1 second here. So, we've been learning so far, we started really into the corporate tax aspect, was Chapter 12. We went all through the calculation of taxable income and tax payable through those, the basic tax rates and all those reductions to your tax payable. What we were working on in Chapter 12, I'm just going to write this down here. Let's use some blue. So in Chapter 12, what we were learning about was what we would call Part 1 tax. So there is more to this story. So Part 1 is your basic federal tax. That's what we were learning all about in Chapter 12, basic corporate income tax. But we do also have some additional rules. So we're really now just building on top of what we learned in Chapter 12. And this Chapter 13 is about the taxation of your investment income within a corporation. Once again, we're giving a different treatment to what we would refer to as passive income. It's going to get a different treatment than our more active Part 1 income. So that's what we're going to be looking at in today's lecture. This one's going to be pre-recorded. As you already know, you're listening to a pre-recorded. If you have any questions as you're listening to the pre-recorded lecture, please make sure to feel free to just go ahead and put that into an email, send it to me, and I'll get back to you with an answer as soon as possible if there's any parts that didn't make sense or you need a little more clarification on. So one of the topics we've kind of alluded to or mentioned before in Tax 1 and Tax 2 is this concept of integration. So if we have this second layer of a corporation being involved, we have our income, the source of income coming from, some sort of generated income. Does it go directly to the taxpayer? Right? If you imagine this as the taxpayer. So does that income go directly to the taxpayer? Or, as we get into in Tax 2, is this being filtered through another legal entity, being a corporation? If the income goes direct, or if it follows this path, are we getting the same amount after tax? That's the concept of integration. Now, we aren't in a perfectly integrated system. The system's too complicated to allow for that, meaning we have too many different complications, but we still strive towards that perfect integration. So this extra tax on investment, or this different tax on investment income, plays a part of a role in integration. One of the big things with this integration is the timing of the income. We learned back in Tax 1 when income is earned straight through, say, employment, things like that, it gets taxed right away when you receive it. If the income comes into a corporation first, we have to pay corporate tax, but we don't pay the personal tax until it's then paid to the taxpayer. So we could find a timing difference. And that's one of the big things that can affect integration. That timing difference, the income coming in different amounts at different times, at different rates, causes it to be impossible to have perfect integration, but the system's set up to do the best that it can to keep this the same. We've also talked about splitting income between taxpayers. That would be the other one. You have one income source, but it's getting split to different taxpayers through the use of a corporation. So there's lots of things battling against that concept of perfect integration. We learned back in Tax 1, and you're going to want to continue to hang on to this knowledge, we learned about eligible dividends and non-eligible dividends. So we're going to expand on or continue to use some of this information. If you remember, eligible dividends were coming from our, high rate. Actually, I should hang on. I should erase that because I should use the proper terms here. It's the high one, but this is what comes from your general rate income pool. And that's, for lack of a better word, that's the high rate stuff. The stuff that does not qualify for the small business deduction. Then we had our non-eligible dividends, which had a 15% gross up and a federal tax credit of 9/13. And those ones were the ones that came from our low rate income pool, or, small business rate. So because the income came in to the corporation and was taxed at either that general rate or the lower rate, it has to flow to the taxpayer based on which rate was used, so that we can keep this integration. Another concept with this is that income earned has to keep its characteristics as it flows through, right? If the income is capital gains, those characteristics should flow through as it comes to the taxpayer. This is also a concept we'll learn about when we talk about partnerships. You can't use a corporation to change the characteristic or the type of income. We have to keep those rules consistent. This is all for purposes of integration. So we have this concept of eligible dividends. Again, those are the ones at the high rate, and they get a higher gross up and a higher tax credit. Basically, the concept there is the taxes that have already been paid. We learned about this before, right? So the gross up is to show that the taxes that have already been paid come packaged with that income to the individual. And then the tax credit is to show we already paid some taxes, because we also don't want to have to pay the same tax twice. So we have to factor both of those parts in. So for public corporations, you're going to find generally that they have eligible dividends. And for CCPCs, you're going to, Canadian Controlled Private Corps, you're going to see that they're generally non-eligible. However, each of those will have balances. These guys will have balances from the low rate, and these guys could potentially have balances from the higher rate, from the general rate. So that's just speaking in generalities, but they both can have a mix. but often public corporations will pay a higher tax rate, and your CCPCs will be able to take advantage of some of those benefits for Canadian-controlled private corps and pay a good chunk in the lower rate area. So that whole concept was from back in Chapter 7. So if you need to give yourself a little refresher on that, that stuff's available to you. I believe everybody has access to the Tax One textbook as part of this whole package. So if it's been a little while since you've looked into that topic, you could do a little refresher there in Chapter 7. These slides are just kind of saying the way the system's set up right now, it's assuming different tax rates, but then in reality, those tax rates they have a range. So you're depending on where you're at is going to affect integration. That's just, kind of for interest here. But there's a range. We know that we have a range depending on what province you're in and all of that other stuff that we learned about back in Chapter 12. So I'll just kind of scoot through that part. Okay, so that's the lay of the land, what we're talking about here. That's just kind of setting the table. Some of that's refresher from Tax 1. So we said that we covered Part 1 tax in Chapter 12. We also have, so Part 1 basic income tax. We also have some other stuff going on here. We potentially have some refundable taxes on our investment income in a corporation. So first off, what are we talking about when we say investment income? We have this concept of aggregate investment income. What is our definition? Well, this includes net taxable capital gains for the year. So net reduced by any net capital loss carryovers that we chose to deduct. So whatever happened in the current year, again, net, that's your gains minus your losses in the current year. That gives you your net number. And then we're reducing that by any carryovers that we chose to use. If we didn't choose to use them and we still have them, sitting to the side waiting, those ones we're not worried about, just the ones we decided to deduct. So that's one. So basically our capital gains stuff is included here. Interest, rents, and royalties. These are what we include in aggregate investment income. You will note that for this purpose, it excludes dividends. Now, normally we would think of dividends as investment income. You buy some shares, you get a return on that through dividends. That would be a passive investment source of income. For this purpose, this word aggregate investment income, this definition specifically discludes dividends. And the dividends we're talking about are the dividends which are deductible in computing our taxable income, right? So we learned about those in Chapter 12. If they're taxable, or if they're dividends that came from a taxable Canadian corporation, we don't, and they're coming to another corporation, we don't tax them in the middle. Otherwise, we would be messing with that integration. We would be doubling up the amount of tax. So in other words, if a corporation has earned income and paid their tax, and then they want to just transfer that net, income through the form of a dividend, that after-tax income in the form of a dividend to another corporation, that just slides over to that corp. Then when that corp pays it to an actual tax-paying individual, a human, then the other part of the tax is paid. That would be different if it was, dividends coming from some foreign corporation or something like that. So basically, we're only ignoring these if they're the same type of dividends that are computed in here with taxable income. So it's a little different than our everyday concept of investment income. This is called aggregate investment income. So that's one concept here. We also have adjusted aggregate investment income, and that's got a different definition here. This is going to include dividends from taxable Canadian corporations. It includes only capital gains or dispositions of assets not used in producing active business income, and there's no deduction for net capital loss carryovers. So that's a different concept, adjusted. So let's get down to actually talking about some of these taxes. We have one here, ART, or ART, Additional Refundable Part 1 Tax on Investment Income. Not to be confused with the basic Part 1 federal income tax that we learned in Chapter 12. This is an additional Part 1 tax, but it's refundable, and it is a tax on investment income. So what is it? It is calculated as 10 2/3% of the lesser of. So we got one of these lesser ofs. Here's where our aggregate investment comes in. So it's going to be 10 2/3% of the lesser of these two. So one, the aggregate investment income that we just learned about a couple slides back, not the adjusted one, don't worry about that for now, but the aggregate investment income, basically what you'd normally think of investment income, less any loss carry forwards you used, and not including your dividend income, the same dividend income that you would have deducted for purposes of calculating tax payable. So the lesser of that guy, or second, the amount, if any, by which the corporation's taxable income exceeds the amount eligible for the small business deduction. So in other words, do we have any income over and above the small business deduction amount? So say, for example, if your small business deduction, if you were using the full cap of 500, but your taxable income was 600, you are 100 over. So basically you have 100,000 of income that's going to be taxed at the general rate. So 10 2/3 of that amount, or aggregate investment income, whichever is lesser. So if you have no aggregate investment income, if this was 0, then that's the number you're going to use. And there would be no additional refundable Part 1 tax. So this is really only going to occur if you have, aggregate investment income as defined here in the Act in Section 129(4). So this refundable, and we will get to that, this refundable Part 1 tax on investment income is 10 2/3 of the lesser of those two. So this kind of creates a bit of a problem. So this, we've learned about Part 1 tax. We're already getting taxed on all of this stuff, right? It's just taxable income times a rate. So why are we adding more to it? This seems like a problem. We would have an excessive tax rate on the flow through of a CCPC's investment income. So if you include this ART, you're going to be taxed at a federal rate with this is referring to your Part 1 plus this additional refundable Part 1. So we'll just call this add Part 1. So you're going to get your regular Part 1 plus an additional Part 1. So you're going to have your 38% general minus your abatement of 10%, and then plus this 10 2/3 on that specific investment income. So that kind of creates a problem in that income is being excessively taxed at 38 2/3. And then you add your provincial tax rates on the same sort of income, which is going to have a range different in every province, from 11.5% to 16% as of 2019. So now you're talking about 50% to 54%. That's a pretty high tax rate on that investment income. So just an example here, 100,000 of investment income earned inside of a private corporation, and you're going to pay 54,000 in taxes. Then you pay that to the individual shareholder. At that point in time, you would have paid $73,000 of tax, earning 100,000 of investment income. So this, I sure as heck think that would be a problem. So how do we solve this problem? What is the solution? Well, one, if the corporate tax rate was lowered, the use of a corporation would provide deferral on the investment income. This is what this whole thing is all about. Deferral. Remember, in a corporation, we have control of the timing of when the individual pays that portion, the personal portion of the tax. The corporation earns the income, it pays corporate tax, and then it pays the individual the money, and then the individual pays their piece. But the corporation can decide when to have those dividends be declared and paid. So if we lower that corporate tax rate, it gives more potential here for deferral. So this weird system is a better solution. So what we do is we keep the corporate rates real high, what we just discussed. However, we kept saying that word refundable. This is a refundable tax. It's a timing issue. So in other words, when the corporation earns that income, it's going to get taxed at this gross, disgusting high rate, which is going to motivate them to then pay out the dividend to the individual, so the individual pays the tax. So when the corporation distributes the income as dividends, that Part 1 additional tax is refunded. The refund is equal to 38 1/3 of the dividends paid. So that initial high rate eliminates the possibility of the deferral most of the time. If the corporation earns that investment income, it has to pay these really high rates. So it motivates them to flush that money through the rest of the system rather than holding it inside the corporation. Because by paying it out, they will be able to get that money back through the refund of that refundable Part 1 tax. So one of the things that you guys, we're building on what we learned in Chapter 12. So one of the things you may also have to do in a question is look at the situation, calculate that, general Part 1 tax, but then also look at refundable Part 1 tax that would also be relevant. So here's a little example. We have our corporate income at 100,000. That gets taxed at 54%. Then we have a balance before the refund. Well, then we get a refund. That refund was this maximum. So if we just go back one here, just as a reminder. So the refund is equal to 38 1/3 of the dividends paid. So here's where dividends paid matters in the question. You may be looking at a question where the company has earned dividends and also paid out dividends. So you have to make sure you know what you're looking at. So be very careful in questions, to recognize when there's dividend income, right, that the company has earned from its shareholdings in other corps. What type of dividend income is it? Is it from another CCPC, or is it, say, foreign, or something like that? Is it from another Canadian taxed entity, I should say, or is it from, say, something foreign? And then also we would have our dividends paid. So those have two different treatments. So we have to recognize that in this whole situation. So the dividends paid are irrelevant for what we learned in Chapter 12. But here in Chapter 13, they become relevant because they can create potentially this refund of 38 1/3% of the refundable Part 1 tax. So here, the dividend was 74,594. So when we multiplied 38 1/3% by the dividend, we got 28,594. That was our dividend refund. So you have the tax at 54, but then we have a refund. That's why we had enough money left to pay out a dividend of 74,594. So basically, this puts us at the end of the day, if we flush out, meaning pay all of that investment income out to the shareholders, then this reduces the overall tax rate in this scenario here to 25.4%. So this is a Part 1 refundable tax. It's an additional refundable Part 1 tax. So it's a little bit extra or a lot bit extra, depending on, again, if you have no aggregate investment income, then it's just a zero. So this is a tax we're going to pay, and if we pay out dividends, it'll offset, and we can potentially get a refund. Now, you could get that refund the following year. There's nothing to stop you from paying dividends the next year and getting the refund the next year. But this eliminates, because you've paid the higher tax rate, you have no benefit of deferring. In fact, you want to pay out the dividend so you can get that money back, get that tax money back for the ART. So that's one. Now we got another one of these suckers. We've got another refundable one. This one is called, we're skipping ahead to part 4 tax. So this is the next one that we're going to talk about. So let's go ahead and talk about this one. So we're done with the additional part 1 stuff and that refund. We have another potentially refundable tax, and this one's called part 4. We've skipped ahead. There's no 2 or 3 to worry about. We're going right to part 4. So in this example, we have $100,000 of investment income. That money goes to Company A. Company A is going to pay $54,000 of tax and has the potential here for this $28,594 refund. Same numbers we were looking at here. There's $74,594 retained. Exact same numbers as this example. So again, this is the dividend amount that's available because the refund has given us back $28,594. Without this, we would only have $46 in the bank. So Company B, if this money goes from Company A to Company B has retained the $74,594. Well, Part 4 tax. This is a liability. This is for private corporations. You know, if you do work here in Halifax, we have a lot of the work you'll do is probably going to be with CCPCs, Canadian controlled private corporations. That's where a lot of the work comes here locally. Also, subject corporations. That's will be liable for this tax. That is a corporation other than a private corporation who is resident in Canada and controlled by or for the benefit of an individual or related group. For the purposes of Part 4 tax, they are treated as a private corporation. We're going to talk about this whole related groups, related associated, and a bunch of stuff like that in Chapter 14. So don't worry too much about this subject corporation thing for now. But private corporations is where you're going to see this Part 4 tax. Part 4 tax is assessed at 38.33%, and it is also refunded at the exact same rate, 38.33% of, once again, taxable dividends paid. So we're talking about the same sort of thing, a refundable tax. Where is this applied? Well, this is for dividends that are received from an unconnected company, i.e., portfolio dividends. So a dividend that is received from an unconnected company, i.e. a portfolio dividend. We'll define a connected company in a moment. The other one is a dividend that is received from a connected company, and the company paying the dividend received a dividend refund as a result of the payment. So we're working now with money going between corporations. With the Part 1 additional refundable, we were looking at the corporation, earning it. We were ignoring dividends coming in, the same ones that we were taking out for tax purposes. They weren't a part of that calculation. So we're kind of coming over here now and picking up those dividends that are flowing between companies. That's what the part 4 one's about. So this could be dividends received from unconnected companies, a portfolio dividend we'd call that, or dividends received from a connected company, and that connected company has received a dividend refund. So in other words, you float it through from one company to the other, got your dividend refund, and now we're looking at it. So let's take a step back here and define this connected company. So what we're talking about here is corporations, of course. So a connected corporation is a controlled corporation, is one example. So this is an either or. This situation here, we're saying either or. So one or the other. So first of all, a controlled corporation, control being defined as greater than 50% of the voting shares by any combination of the other corporation and persons with whom it does not deal at arm's length. So basically, one corporation is connected to another one that it controls through those voting shares. And to control, that would be more than 50%. Or the second one is a corporation in which the other corporation owns more than 10% of the voting shares. And this is an and 10% of the fair market value of all issued shares. Remember, every share issued isn't necessarily going to be a voting share. So if there's different classes of shares and some are voting and some aren't, we need 10% of the voting and 10% or more of the fair market value of all shares issued. So this is a greater than or equal to 10%. So it's kind of worded in a weird way. Obviously, if you control a company, then you're connected to it. You control it. But the real bar here is simply greater than 10%. That is of voting and fair market value. So it's a very low bar. If you have both, then 10% is all we're looking at. So that 10% in practice, that 10% shareholding test is generally what we would use to determine if these are portfolio dividends or dividends from a connected corporation. So we use that 10% test to figure out which this is. So we've already defined eligible dividends. There again, non-eligible dividends. You guys learned that back in Tax 1. So CCPCs, their income is often first eligible for small business deduction. We learned that in Chapter 12. Investment income is often eligible for a refund. This assumes most dividends are non-eligible. So there are exceptions for the general rate income pool. We keep track of that, by the way, that general rate income pool, so we can figure all this stuff out, all these dividend refunds and everything. For public companies, most of the income is going to be taxed at the general rate. So this assumes that those dividends are eligible, and then we're going to have exceptions for your low rate income pool. So you may be asked to calculate these income pools. So we have a nice little formula for that to calculate our GRIP. And this is something we continue to track. This is a cumulative total. So C is going to be your opening balance. Then we're going to have D, 72% of the adjusted taxable income for the year, which is regular taxable income reduced by the amount eligible for the small business deduction. We talked about that a little while ago. And the lesser of the CCPC's aggregate income and its taxable income for the year. So these things, I mean, really, this is a pretty dry topic, obviously. Make sure you refer back to this stuff because there's a lot of information there in particular. So make sure you're calculating against the right thing. What is adjusted taxable income? What's aggregate income, investment income, all these numbers? Make sure you just refer back, have those things available to you so you can refer to them. E is the eligible dividends received during the year. F is any adjustments for amalgamations or wind-ups. I'm not going to give you a big complicated amalgamation or wind-up question. Tax 2, again, is, we're working on some of the basic stuff here in chapter 11, 12, 13. And then, as we kind of continue, some of these chapters, they could be a whole course, right? It gets into some topics you could really get into, but we're still really just introducing these topics. We're trying to give you the basics here, and I don't want to get too mired in too many, really complicated items that you're not going to necessarily see day one in the job. But just know that amalgamations and windups, there's some different stuff for that. This is when groups of companies are joining together or a company is shutting down, ending its life cycle, so to speak. G is eligible dividends paid during the preceding year. It's highlighted. It's not the current year. It's the preceding year. So that's how you would calculate what is available in that income pool. Why does that matter? That's the pool of income from where you will pay your dividends. And then we have to follow the appropriate rules for those dividends. So these would be eligible. Out of your GRIP comes your eligible dividends. That's what this slide is saying here. As much as you have in your GRIP balance, you can have eligible dividends. And they have a little bit of a preferential tax treatment because more tax has already been paid because it was paid at the high rate in the corp. And our LRIP, our low rate income pool, we got a big old crazy calculation for that one too. If you like punching formulas, there it is. Again, this is a cumulative kind of all-time carry forward balance. So we have the opening balance from the end of the preceding year is where we start. So that's always going to be A. Then the non-eligible dividends we received for the year. Because again, these corporations can be paying these dividends to each other, to connected corporations, to corporations that control them. So it's not always going to an individual. It can be going to a corporation. So we have to flow these things through properly. In the big picture, again, it's about keeping the characteristics consistent so that we don't change the tax treatment as the income moves through, maybe a more complicated corporate structure. So your non-eligible dividends are what's going to get paid out of your low rate income pool. So they'll be categorized as non-eligible, and they have a less preferential treatment to the eligible ones because they've been paid out of a pool of income that was more likely small business deduction rate and had the lower corporate income tax paid to come along with it. And all of this stuff, all of this nonsense is to try to keep that integration, try to eliminate the benefit of kind of moving this money around to maybe defer when the taxes need to be paid. Instead, as you move it around, you create a bigger tax bill so that you have to, or as you earn the investment income, you have that bigger tax bill until you move it along. But then if it just moves along to another corporation, now it's that corporation's problem. We're trying to push it down the line to the individual so they can pay that final amount of tax to lessen the amount of the deferral. That's what all of this, that's the goal of all of this. So it's all still about integration. We make elections on the tax return for this. So you have to specify when you're paying a dividend, you elect to pay it out of one pool or the other. So it's important that you've done your due diligence and you know how much is in the GRIP, how much is in the LRIP, and so you properly take it out. So there can be some tax if you do an excessive election, if you go past what you had left in the pool, 20%. If it's an artificial manipulation, 30%. So there's some punitive stuff in there for overdoing it, right? Because this can drive dividend refunds and all this stuff. So you got to track those balances carefully and not make any mistakes, or certainly not artificially manipulate it on purpose. So then we have another one here. Refundable dividend tax on hand. This is how much we have in the pot. So in other words, if you have paid the additional taxes, right? So you're paying those along the way, you're building up a pot until you pay the dividends to the individual. So, you know, whenever this, let's just to kind of simplify it, you know, you've got this investment income. So you got this investment income, you know, it's coming into your corp, and then you're paying taxes on it. You know, you're paying these refundable taxes, the Part 1 and the Part 4. So you're building up a pot of refundable taxes. That's our RDTOH. That's a D. Refundable dividend tax on hand. This is another cumulative pot. So we're calculating along the way here, how much have we paid that extra tax on? Part 4 and Part 1. How much extra do we have sitting in the pot, which is refundable? Once we pay the dividends out, then we can refund it. Now, there's been a change to this, you know, just to kind of complicate things a little more here. So before 2019, so this is a change for the current tax book and for the current tax rules here. So before 2019, a company would just maintain one account for all of this. So it was more simple. We've complicated it a bit more. So all of your refundable taxes were dumped into one pool. And then your refund was the lesser of 38 1/3 of any taxable dividends you paid, or the balance left in that account. So that was pretty straightforward. You pay out the dividends, you can get back your 38 1/3% up to whatever's left in that pot. Over and above that, they're just regular dividends. or I should say, they're dividends that have no effect or have no refund coming to them. Now, from 2019 forward, we've got some new rules. And basically, instead of having the one pot, now we've got two pots. And one is for your eligible refundable dividend tax on hand, and one is for your non-eligible. We're going to keep track of them separately now. So there's no refund on eligible dividends if there's no balance in your eligible RDTOH. So it's a little more complicated, but it keeps track of it evenly. So you used to be able to just pay it right out of one pot and it didn't matter. Now you have two separate pots for that. So the importance here is that non-eligible dividends are taxed at a higher rate than eligible dividends. So in other words, if you want to access, that's what this one here is saying, if you're trying to access the refund and get the dividend to a person in the most tax beneficial way for them, for the individual taxpayer, it's a little more challenging to do that now because you have to take it out of the appropriate pot. In other words, once your eligible dividend, refundable dividend tax on hand pot is gone, you can keep paying eligible dividends. However, they may not get you a refund. So you may need to go over here and pay some non-eligible dividends to clear out what's in that pot. It used to be it didn't matter. It's one big fat pot. So it's a little more complicated now with that, and a little more complicated because we have to track them in those two ways. So how do we get there? There's some transitional provisions for this. I'm not going to give you guys a big complicated question about the transition, because obviously if we have one pot, we need to get to two pots and then move from there. So that's kind of a, that's only relevant for 2019. So we're not going to spend too much time on that, but there's information there in the text for you on that and about how you kind of transition through. So there's slides here for everything that goes into those two pots. Let's see here, your eligible refundable dividend tax on hand, Part 4 taxes on portfolio, Part 4 taxes on eligible, of course, deducting. So you have an opening balance, you add stuff, you deduct what you pay out, right? Just a running tally of that pot. Same thing for the non-eligible. What did you start with? We got to deal with the transitional rules, but what did you start with? Plus the additions here, it's the Part 1. So that goes in the non-eligible. We already learned those. And then Part 4 on eligible. So this was Part 4. So for the eligible RDTOH, it's Part 4 taxes on eligible dividends received from connected companies. I want to just highlight for you guys here. This is the difference. Right? Refund on non-eligible, refund from eligible. That's the difference here. So these two both include Part 4 taxes related to connected companies, but this is for the non, and this is for the eligible, because we have pots for each of those now. That's the key difference there. And This non-eligible is where all your Part 1 stuff goes. And this eligible is where the portfolio dividend Part 4 taxes go. So basically the rule to keep in mind here is that all of this stuff, when you've got your general rate income and your lower rate income, that's 2 lanes, and everything's got to flow in those 2 separate lanes. If you're doing dividend refunds on eligible and non-eligible, it's all tracked now fully individually through the whole life cycle. And so you can only pay from those groups. And you're going to have the tax implications of that. These ones a little bit. So the last thing that we have on this chapter in the slideshow here, there is an example. The example here is from the text, paragraph 13, 163. Now, one thing I can kind of promise you guys on this section, I'm not going to, give you guys the most complicated question in this category, but I am going to want you to be able to do some of these basic calculations, right? Make sure to, appropriately calculate your refundable taxes and how much of a refund there would be, your balances in your refundable dividend tax on hand accounts, just some of the basic calculations with that. You'll notice in assignment 2 is not as big as assignment 1. Shouldn't take you as much time. I went pretty light on this section. So I know we kind of time constraint here leading up to the final exam, and I want you guys to be able to get that done. And then also prepare, go through the solutions and whatnot and prepare for the exam. So, but, it could be a little more complicated question than what was there on the assignment. So this one here, this is kind of a basic situation. This kind of rolls through and gives you all the calculations, an example of all of that. So this one, uh, 13-163. Let's try to. Here it is. So this is on page 672 of the text. If you're looking for this example. So it runs through the text there, gives you a good example of how you would kind of crunch these numbers. So certainly this section's not fun. Hopefully this lecture gives you at least some context as to what we are doing and why we're doing it. But this, a lot of corporations are going to have some investment income. So it is something that you will have to learn how to navigate. So let's have a peek at this one. So Fortune Limited is a Canadian-controlled private corporation. Based on the formula, 90% of the company's income is earned in a province. The following information is available for the year ended 2019. So remember how that affects where the province, or if any of the income isn't earned in a province, that can affect your calculations. So in the text, they basically gave you all the different components of the taxable income, gave you the opening balances, to the refundable dividend tax on hand, and all of the relevant kind of accounts that you would need to look at. So all that basic data is provided. All the opening balances, right? So the end of 2018 is our opening balance for 2019. This is all the same data that's in the text. So we know that our GRIP, our general rate income pool, opens at 20,000, and we know that eligible dividends paid in 2018 were 8,000. So there's our GRIP at 12. We have eligible refundable dividend tax on hand is going to be 4,600. How did we get there? It's the lesser of our transitional number and 38 1/3% of GRIP. So we had to calculate that and then do 38 1/3%. Over on the non-eligible side, we should have here opening RDTOH balance 23,000. This is towards the bottom of page 672. And then the opening GRIP balance of 4,600 gives us our 18,400. So in this question, we have a calculation example of your part 1 tax payable. So the wrinkle we've added, right? So we know the abatement issue here with the 90. We learned that back in chapter 12. But the thing we've kind of added here is our additional refundable part 1 tax. So we have to remember to calculate that, as we talked about in the slides. So you go through, pick the appropriate ones, do the lesser of, and there it is. So there's an example of that calculation there for you guys if you want to go through that. So remember that ART, that refundable part 1 tax on investment income, that additional amount that gets added, that becomes a part of our tax 1 payable. So this is adding a little more wrinkle to what we were learning and calculating back in chapter 12. And this is a tax on the aggregate investment income, which was basically like everything but dividend income. And it's 10 2/3% of that number. Also, it's the lesser of aggregate investment income and the amount of taxable income. So if you don't have any aggregate investment income, well, then you're not going to have any of this. So that's just capping it off. So make sure, though, that you do show all of your work, meaning when you have a lesser of, whenever you have that lesser of, do both calculations. And then pick the lesser of, just like they did here. So, for example, if we break down the calculations that we have here, they're both 10 and 2/3, right? And one of them is aggregate investment income. Our net capital gains reduced by any capital loss carryovers deducted, interest, rents, royalties, excluding any dividends that were deductible in calculating taxable income. So in this case, ignored. That was the 30,000 in this question. So, and when you're, for this example, you probably want to pause the video here, have a good look. It's a few pages long, give yourself a familiarity with the question, because I am kind of just skipping through this kind of quickly. But the aggregate investment income is what we're calculating right here. So the 100,000 is your Canadian source investment income. That's 100,000. Then we also have 20,000 of gross foreign non-business income. We also had 30,000 of portfolio dividends, but those were deducted for tax purposes, meaning they were taxable in Canada, so we're ignoring those ones. But we did also use a $15,000 net capital loss carry forward as a deduction. So those are the three components, the 100, the 20, and then reducing by the loss carry forward that we used. That's our aggregate investment income, and we multiplied it by 10 and 2/3. That happened to be the lower in this calculation, and so we chose it. But that's an example of a question where you're calculating that aggregate investment income for purposes of Part 1 tax payable. Now remember the first part, the other thing we compare to, this was back on slide 13 if you want to refer to it. We had the corporation's aggregate investment income times 10 and 2/3%. So we just did that. That's the second row. The first row, what this represents is that amount, if any, by which the corporation's taxable income exceeds the amount eligible for the small business deduction. So this is just taxable income minus how much we're eligible for small business deduction, multiplied by 10 and 2/3. So the taxable income that's in the blue bar in the middle of page 672, 265,000 minus, now it's not always going to be 500. Maybe you're sharing it, whatever. In note 1 on page 673, there is the calculation that we learned in chapter 12 about our small business deduction. So that one had 3 options, and active business income was only 150. So that's why we're subtracting by 150, because that's what we ended up having as our limitation for small business. So you're not always limited to 500. You have to look at those 3 options in the formula. So you would have already had to have calculated that to be able to do this. So we picked the lower of these two, and there it is. What else do we have going on in Part 1 tax? Foreign business credits have to come out, right? If you've paid foreign taxes, you'll notice on page 672, there was foreign non-business income, 15% of 20,000. That's our 3,000. And there was gross foreign business income with 15% withheld on 10,000. That's our 1,500. So this foreign tax, it's been withheld at source on the foreign earnings, so we can claim a credit for it so that we don't have to pay that same tax twice. Same kind of concept as what we learned back in tax 1, where we said, Canada wants to be paid tax on your worldwide income, But if you paid tax in the other country already, you can claim the credit for what you paid. But say if that company or that country had a 10% tax rate and Canada has a 20, well, you paid 10, but you still got to pay the other 10. So it's the same sort of concept here with the corporate stuff. Small business deduction, we've got that as question marks there. Here's the calculation of that. And that's same thing is provided on page 673 of the text. That's what we were talking about a moment ago. These are the same two foreign credits. So this right here is just the formula that's provided. All you had to calculate was those two withholding amounts. So one was 15% of 20,000 and one was 15% of 10,000. The rest of this is just plugging into a formula, factoring in those foreign credits in relation to the taxable income in order to get to small business deduction. So they factor those in for that part. So we know already we ended up at the 150 because that was the lowest number. And that was calculated as active business income. Once again, showing that active income is going to get the preferential treatment. As soon as we start involving a whole bunch of passive income, such as investment, we're going to have a less preferential treatment as far as the Tax Act goes. So now we can, these slides are just kind of slotting in these extra things as we go through. Everything's the same. And then, whoa, what's our general rate reduction? Well, general rate reduction is the one we're always going to calculate at the end. And we're always going to subtract everything else that we've already kind of worked with until we know that all we have left to pay full rate on is going to be the 10,000. Our GRR rate is always 13%. So it's just 13% of the 10,000. Taxable income minus the amount that was applied for small business deduction, minus, here's the new wrinkle we're adding, minus aggregate investment income, because it's had its own treatment. So the only one that you're getting the 13% reduction on is the 10% in additional. There's no, so effectively what this is saying is there's no 13% reduction for small business income because you're already getting 19%. So you don't need it. Don't worry about it. And for the aggregate investment income, we've got a whole different set of rules here that we're dealing with this, with potential refunds and extra taxes and all that other nonsense that we've been learning in chapter 13. So there's where we end up in that example in the text for part 1 tax payable. So again, I gave you guys a little bit easier question on the assignment, but you will need to be able to potentially calculate things such as what's in this example. And the only wrinkle we've really added here is that refundable part 1 tax that we calculated. So that's something new to add to what we learned in chapter 12, coming to that same number, part 1 tax payable. So it's the same number we learned in chapter 12 with a new little wrinkle added to it. When and where appropriate. So that was 11,200. Taxed, the rate is built right in there. So this is an add. Notice the way we've always been taxing this is, or calculating this is figure out the big number, here at 38. And then we're subtracting, just keep, some of them are called deductions. I don't love that word for this, but we're reducing. They're reductions. They're almost basically tax credits. Reducing it. This one we're adding. So just be careful to keep in the proper order so that you can calculate your rate reduction, because that part will factor in, or the aggregate investment income will factor in. But make sure you're careful with the fact that we're adding this one. This is not a reduction to tax. We're adding a refundable amount to the calculation. So that's everything in that example, getting us up to Part 1 tax payable. So the Part 1, that was our Part 1 payable. Now what about our Part 1 refundable? So refundable is 30 2/3% of our aggregate investment income. So we already calculated that. We know it's 105, right? We calculated that back here, 100 plus 20 minus 15. We do have to do a little more work on this refundable, though, because of the foreign content. So the foreign non-business tax credit's going to come out. And this over 8% foreign investment on the 20,000. These offset each other for a net negative of 1,400. So our refundable tax is 30,800. So the little extra wrinkle there is that we have some foreign component to deal with. So this, just to clarify here, this Part 1 refundable, we are calculating here in these slides. I'll just call it 1, then 2, then 3. So the refundable portion in this case is equal to 30,800, which is the least of the preceding 3 amounts. So this is as per, the rules, what we're going to calculate, these 3 different totals. And again, it's a lesser of based on your formulaic calculations here that we looked at earlier. So in this case, the first one was the one we were using, but you have to show all your calculations for all 3. That's where you earn the points. And if you make a little mistake along the way, that's okay. You're earning the points by showing as much of that work as you possibly can. So that's everything we needed to worry about for our Part 1. We calculated our Part 1 tax. We calculated our Part 1 refundable by doing the 3 calculations and picking the least. And then we got to deal with our Part 4 refundable. So on the portfolio dividends, which was 30,000. So again, the portfolio dividends are just dividends from Canadian companies that we are not connected to. Basically, we've invested in some, tax-paying Canadian companies. We have deducted that from our calculation. It comes out of our net income for tax purposes to get to taxable income. They are not taxable at that level, but we do have, as these dividends, again, they're flowing through, right? So you have the corporation, the corporation that you invested in. I'll just call this Invest Corp. So you as the corp have invested in this. You own shares. It sends dividends to the corporation that you're doing the taxes for. I'll call this Tax Corp. So because these guys already paid tax, right? They already paid tax. So we don't have to, so there's no more tax here. But as we're receiving it, we may have to do some of this refundable tax because we want to eventually get this money, the Tax Act, to the, the individual taxpayer, right? The actual human being, when dividends are paid here, this is when we're going to get that last part of the tax, right? So they paid corporate tax. We need to pay the personal tax. Through here, it's not going to happen. This is just a flow through. So in order to disincentivize the flow through without getting all the way through, we have this additional tax, but it's refundable. You can get it back. You just got to pay out those dividends. That's what this has all been about. So on the 30,000 in this example, you've got 38 1/3, on the 30,000 of portfolio dividends, it's 38 1/3% of the 30,000, giving us 11.5 of refundable Part 4 tax. So then, after with all of that's figured out, now we're talking about our balances in our refundable dividend tax on hand. So wherever you see this transitional balance, that's just talking about how we broke that balance into two at the start. If I give you any questions, I'll kind of give you, I'm not going to make you guys calculate the transitional balances. I will just give them to you, if it's in the question. So here, the transitional balances are available for the eligible RDTOH. We put the Part 4 tax on the eligible dividends. That's the 11.5 we were just looking at a moment ago. Those were eligible dividends. That should be mentioned here in the question. The portfolio dividends would normally be eligible dividends. So that gives us our balance of eligible at the end of the year. Same thing, starting balance. We calculated our Part 1 tax. We add that in. That gives us our ending balance. And then we can look at our GRIP. Opening balance is given. We received portfolio dividends. Those are getting taxed at the high rate. So those add in. So now we have 42,000 in our general rate income pool, income that can be paid out as eligible dividends. Get a bit of a preferential tax treatment because higher tax rates have already been paid. The dividend refund. If we have an allocation of 60, 42 designated as eligible, the remaining 18 designated as non-eligible. Remember, because we are tracking an eligible pool and a non-eligible pool, when we pay the dividends, we are going to, we always have to keep track of those dividends regardless, but as we're paying them, that's going to affect our dividend refunds because the refundable tax on hand is in two pools. It has to come out of those pools. So then we can do the dividend refund. For eligible is the 42,000 paid. So 38 1/3 is the rate, the refund rate. Remember, it's the exact same as the taxed rate. So 38 1/3 on the 42, the lesser of that, and the ending balance that you have. So in other words, we only have this in the pot for eligible refundable dividend tax on hand. So that is, well, I guess best way to just simply put that is that's what We had 16,100 in the pot, so that's all we could pay anyway. So that's all we should pay as the 42. 42 times this is 16,100, so the lesser of the two of these is the same number. So we subtract that out to get, at that point we've used it all up. We wouldn't want to go farther than this because there's nothing left in the pot. And then you have the refund on the non-eligible, lesser of, same. We called 18,000 of it non-eligible. So 38 1/3 times that. But we have to compare that to how much is in the pot. Well, we got lots in the pot on the non-eligible side. So we just pick 38 1/3. So the only reason why we're doing lesser of here is to limit it to what is in the pot, so to speak. And again, we have two pots, a non-eligible and an eligible pot to draw from. So when we take all of that and figure out our total federal tax payable, where are we going to end up? Well, we calculated our Part 1 tax payable at $53,750. We calculated our Part 4 tax payable at $11.50, and then we calculated the two different streams of dividend refund for a total of $23,000. So it's Part 1 plus Part 4. Inside of this one, by the way, was that ART, the ART, right? The additional Part 1 stuff. And we had the Part 4 stuff. So all of that added together, minus the refund that we can claim because we paid out dividends through those two channels, leaves us at our total federal tax payable for the year. So obviously you can see here from this simple slide that we were able to recover, due to the dividends, $23,000 of the tax. So if we slide back, how much was our ART? I forget what the number was here. Oops, yeah, Part 1 refundable. The ART was 11,200, I think. Yeah, because it was the lesser of doot and doot, 11,200. We had to do these 3 slides. Oops. So we picked 30 there. That was our Part 4. Yeah. So our ART ended up being 11,200. So if you look at this, really what I was trying to get at here, all the way back to the end, inside of there, I believe we had 11,200. So, 22,700, you could say, right? If you add the 11,500, just to give it a little context here, this isn't part of what it's asking, but that's like 22,700 of extra taxes. And then based on what was paid out, we were able to recover 23. So these things have kind of wiped each other out to a large extent. One of them is buried inside here, so it's not apparent when you just look at this one simple slide. But you've paid some extra ART and you've paid some extra Part 4, both of them being refundable. You paid out dividends, so you got refunds on the 2 channels of your general rate and your low rate income, and it kind of mostly washed in this question. So you would, as far as a tax planning concept, you would look at how much of these refundable taxes you're going to have to pay, and then use that as a planning tool for how much you will pay out in dividends and what type of dividends based on what you have. So being able to do all of this sets the groundwork where you can plan out these dividends so that you can lessen the impact of this. And that's the whole motivation of these elements being in the Tax Act, is to just move that money along through the channel. Simply increasing the tax rate would be too much. You have to have this built in to promote for the owners of the business to push that through to the ultimate taxpayer, that being the individual. So that example kind of is I guess that's the extent of the complication that you guys could possibly expect in the midterm. The assignment questions a little bit more on the easier, shorter side, just so you guys weren't too bogged down. I know the first assignment was a little on the longer side, and I didn't want to go too big on the last one there. So that's it for chapter 13. There's a few pointers here, procedures on working through bigger questions. That's it for chapter 13. On Wednesday, we'll have a look at chapter 14, which is the last part, and that'll help you with the last couple of questions on the assignment. We will do a small in-class exercise, basically just having you guys try to work out some of these. Like the big part of that is the associated corporation rules, and trying to figure out if a couple of companies are associated for purposes of the small business deduction. So I'll just give you guys a little exercise to work out on your own or in a group, and submit in tomorrow night. Just kind of practicing, getting you guys actively working on some of those type of questions. But we'll also go through and kind of explain all of that and how it affects small business deduction and that sort of thing. So chapter 14 is called Other Issues in Corporate Taxation. So it kind of just picks up on a few other topics, a lot about control, and the associated corporations is going to be the key stuff that we'll focus in on chapter 4, and then we will be all ready for the midterm on Monday. As always, if you guys have any questions about this lecture or any of the other stuff, any of the assignment questions, any of this, please feel free to shoot me an email, and I'll try to get back to you as quickly as I can. So that is it for chapter 13, and I will see you all on Wednesday.